Banking Defined, part of our video series on banking. In this video, we're going to discuss what banks are, the different types of banks. We'll talk about some other related institutions to the banking system. And finally, we'll talk about some banks that are so large they are literally too big to fail. Um, this banking definition I took from a person at the International Monetary Fund. These are banks are institutions that match up savers and borrowers that help ensure that economies function smoothly. I think this is a great general definition, although I do have to mention that some banks actually don't work with savers, and there are a few banks that actually don't work with borrowers. But in general, this is a good definition of what a bank does. Um, a bank, in this sense, is a financial intermediary. Financial intermediaries are institutions that make it easier for two parties to make financial transactions. And pretty much any financial market that we talk about has a financial intermediary in it. Some of them might be a stock exchange, a stockbroker, a mutual fund, a pension plan, an insurance company. All of these institutions facilitate transactions between buyers and sellers or between two parties, and they're all called financial intermediaries. Banks are the most common one and the one that most people will interact with the most throughout their lives. There are three main types of banks. The first one is a savings bank. This bank is mainly catering to small consumers who want to save their money in a very safe institution that is less about making money and more about providing stability to the people who are saving. The second one is a commercial bank. A commercial bank has businesses as their main customers and who are looking to make loans to small business while taking deposits from all sorts of businesses. Finally, there are investment banks who take money from consumers and institutions and invest that money in ways that are hopefully guaranteeing a high return for these customers, but with a lot more risk that people might lose their investment. So those are the three main types of banks. What's happened over maybe the last 30 years in banking in the United States is that there's been a lot of consolidation. So the bank that you bank with might actually have all three of these functions. But up until, let's say, 1990 or so, these banks all had to be separate institutions with separate functions. If you do bank at one of the large banks in the United States, such as Bank of America or Wells Fargo or Citibank, uh, you are banking at a place that we call too big to fail. And what that means is that if a large bank went bankrupt, if it failed, if it didn't have enough resources to keep going as a business, it would probably cause a financial crisis. And so we have deemed these banks ever since the 2007-2008 financial crisis as structurally important financial institutions, or SIFIs for short. And those again are institutions that we worry about failing and dragging the rest of the economy down with it for reasons that I will get into in my second video. Again, colloquially, these are known as too big to fail banks, and we have these regulations, mainly the Dodd-Frank Act, that are targeted at making these institutions even safer than others. Whether those regulations are effective or not is a matter for debate. I want to talk about a couple banking related institutions, such as credit unions. Credit unions function a lot like banks, except that they are organized by members of some sort of organization, and their profits are supposed to be returned to those members. So, um, in essence, the credit unions are supposed to be for the benefit of the members of this organization, sometimes a company, sometimes a union. And so this membership allows these people in this credit union to provide these same sorts of banking services. Shadow banks are banks that don't necessarily work with borrowers and savers, but might work with other people depositing money or for other investment reasons, such as hedge funds, which are funds that are supposed to moderate or invest in different things than the rest of the market, or private equity funds, all of these other kinds of things that are part of the financial system but aren't banks. Many people believe that these extra parts of the financial system were helped cause the 2007-2008 financial crisis. So after that, we spend a lot more time thinking about how we regulate these institutions and how these institutions impact the financial system. Finally, I want to talk about central banks. Central banks aren't really banks at all in the sense that we've defined them. Central banks are quasi-governmental organizations that implement monetary policy. Typically, they're not officially part of the government. Typically, they're supposed to be independent of the government, but sometimes they are part of the government. If I had another week in this class, I would spend that week talking about central banks and what central banks do. But for now, I can just say that they implement the monetary policy of a country, and the banks that we're talking about, they help implement that policy, again, in a video that I'll show you coming up. So, a bank is an institution that matches up savers and borrowers, and different types of banks, whether savings bank, commercial bank, or investment bank, have different types of savers and borrowers. Some banks are so large that they are too big to fail, and credit unions and shadow banks are also part of sort of the banking financial system. Thank you.